Mahesh Nandurkar joins us. Let's take the conversation forward with him. And Mahesh, good morning. Thank you for joining us. Mahesh, my simple question is that why markets are up 7 to 8% in a matter of 5-6 weeks? The easy answer is liquidity. But that may not be the fact this time, because on one side DIs have bought and FIs have sold. So at a time when institutional liquidity at best is neutral, still Nifty has managed to stage a strong show in last 5-6 weeks. So what is driving the markets? Because now markets are just not only dependent on liquidity.
Yeah, see, the thing is that, clearly we are seeing the key drivers of the market, at least over the last few weeks, have been the domestic investors, clearly. So it's not, you're right, it's not so much just the international liquidity, although international sentiment is definitely, playing out. And over the last 5-6, by the way, India has underperformed the region, although India is the best performing market, one of the best performing markets, say YTD. It is still liquidity in my view, more so the domestic liquidity. We've seen some very large mobilizations made by some of the mutual fund schemes, the kind of numbers that we've never heard before. It is still the domestic investors pumping in a lot of money, not too many other options. I guess that's what it is, looking like as of now.
So what are you telling your clients? Be mindful of the valuations, or earnings will surprise us, and in hindsight valuations will look cheap, because valuations were looking stretched 6 months ago also. They were looking stretched 9 months ago also. But it is the sheer power of earnings which has surprised us, which are making markets, which are making historical valuations look cheap.
Yeah, that's right. That's right, Nikunj. 6 months ago, 9 months ago, also one could have made the same argument. But the thing is, that time, we actually like to look at valuations not just from the perspective of the P multiples or EV by EBITDA multiples and comparing that with history, but we also put that in the context of where the risk-free rate is. And 6 months ago or 9 months ago, that equation was looking pretty decent. Even 3 months ago was looking reasonable in my view, putting the valuation in the context of the risk-free rate. But that's not the case anymore, unfortunately. And very difficult to make a case for the markets to kind of keep giving positive returns from here on. So my, advice would be, and this is what we've been discussing, with our investor base also, is that, absolute returns from here on, to my mind, is appearing a more and more difficult task right now. Especially, we know that at some point in time in the next 2 months, 3 months, 4 months, whatever, you can take your pick, but the taper is going to start. And while the US Fed chair was very categorical in saying that they will be gradual and stuff like that, and we don't necessarily have to combine the rate hikes with the starting of the taper, and the two can be two different events, which was taken very, very positively by the markets, since the weekend. And we've seen upward trajectory on that. But if you take that 2, 3, 4 month type of view, I think there is going to be the beginning of taper sometime during that time frame. And my sense is that difficult to argue for the risk-free rates to go down further from here on. In fact, if anything, they would be moving up. So my sense is that the risk-reward, at least in the, if I take the next 3-6 months view, is looking unfavorable.
Sure. Mahesh, time and again we've talked about the real estate sector, and I was just reading in one of the papers this morning that monthly home sales for the month of August gone by have been the best perhaps in 10 years. We already know since the start of the year that residential sales at least have seen an uptake, and we understand commercial real estate as well is picking up. But what's a better way to play this entire domestic housing revival market? Would it be via the realty plays, or would it be via ancillaries, which includes financiers like, the big boys, HDFC, and the smaller regional plays, or for that matter, via tile, cement, paint companies? Or would you say go for a mix of all, because that's going to give you the best exposure to this, real estate revival that one is seeing in the country?
Yeah, so this has been, one of the themes that we've been highlighting for now more than like last 12 months now. It's been the highest conviction idea for us and continues to be so. I think it's going to be a multi-year theme, which is what we have been highlighting in our communications as well. So the best way to play the housing recovery is clearly through the housing developers themselves, because that's the most direct and the highest beta play that you can think of on the housing market recovery. Also, keep in mind that we are also going through a phase of heavy industry consolidation as well. So it's not just that the housing market is reviving, but also the competition is reducing as well, which is a great news for the existing large players. So that I think clearly is the best way to play. But yes, as you rightly mentioned, there is this whole chain, which is the mortgage companies, the cement, the tile makers, etc. Will also be the beneficiary. In fact, that whole theme continues to look very, very attractive. And so while I mentioned that the risk reward is looking unfavorable for the broader market, there are definitely certain pockets, and this is definitely one theme which should deliver positive returns.
Right. Where is it, Mahesh, that you would tactically end up reducing exposure or perhaps go underweight as well? We've seen the underperformance in pharmaceuticals. We've seen the underperformance in autos as well, of course, for various reasons or individual reasons for both sectors. But do you sense that in a market like this, one can increase exposure to certain pockets while a part of the market can continue to lag and underperform?
Yeah, so I definitely feel that the housing theme that we just discussed definitely looks very, very attractive, where the weightages can be increased. If you look at the valuations, I think there are two sectors that are standing out where the valuations are still quite reasonable. One is the banking and finance, and the second is autos. Both have been laggards. But I feel that from the, if one sort of keeps in mind the kind of risk that we're entering into in terms of the market valuations, banks and, autos are looking like, a reasonable, bet to take, in my view, especially, because autos have been a very big laggard and there have been some issues, understandably so, especially the rural demand has been quite weak. But I would be looking at playing the slightly, higher end version of that, the premium motorcycles and, also the car makers, as a way to play. So those are the two sectors. And I would also add on IT services, because, there obviously the valuations, are kind of completely out of whack with what the history has been. But that is also a sector which should do well, should there were to be a market correction. Also, the demand trends are very, very robust. So the large cap IT names, the banks and the autos are looking like a reasonable, sort of part of the market where one can stay put. I would say, tactically speaking, the valuations of some of the small cap, mid cap names is beginning to look quite stretched in my view, where I think one can possibly take a tactical view there.
Hi Mahesh, this is Mubina as well joining in. I just had a follow-up question on realty. About how the sales have we've seen a good pickup come by in the last couple of months, and you expect this to be a multi-year story. To what extent do you think that this pickup in sales, and I'm sure it is to a large extent, that it's dependent on the very low interest rates that we've been seeing, very low mortgage rates? And further, you've also spoken about how that it's not going to be this case for very long. Real interest rates are going to start rising. The Fed has, spoken about taper, though of course it's been a very dovish commentary still. But interest rates will rise. Do you think that could perhaps hit the brakes on, housing sales?
No, I don't think so. That will not cause, any brakes to be applied on the housing market upturn at all. Because, if rates were the sole determinant, then between 2013-14 down to 2020, when the mortgage rates went down from 11% down to say 6.75 or 7%, those should have been one of the best times for the real estate market, but that was not the case. So what I believe now from here on is that key to watch out for will be the pricing action on the physical asset side. We've started to see the house prices beginning to go up. We've seen about 5 to 10% price hikes over the last, say, 6 months or so. And that, I think, will be the single biggest driver in my view, because over the last 7 to even, I would say, 7-8 years, there has been a huge improvement in the affordability. There is a huge pent-up demand. Many of the potential buyers have kept on postponing the purchase decisions because the pricing was soft. And now that we are beginning to see the prices going up by 5-10%, I think that's a very, very healthy rate of price hike. And in my view, this price hike will bring in more buyers into the housing market. So rising interest rates will be the least of the concerns in my view. We can talk about the impact of the interest rates, once it starts hitting, say, mortgage starts hitting, let's say, 9-10%, which I guess maybe at least a few years away.
Understood. Okay. You spoke about IT. Just yesterday, we were talking to Prestige Estates, and they spoke about the kind of traction they are seeing in Bangalore, which is, of course, the country's IT hub, which goes to say that, yes, IT is we're in a great time. It's boom time, really. They're doling out huge salaries to attract talent, etc. But what makes you believe that we are not yet priced to perfection for these IT stocks? And further, it looks like now there is going to be cost pressure that will come on IT. So what exactly is it that makes you optimistic on IT? Don't you think that the strong growth potential and the double-digit growth guidance has already been priced in?
Yeah, see, the valuations, are at their historical peaks. And you're right in saying that these huge amounts of salary hikes and bonuses, etc., are going to put margin pressure on the companies. That is going to be a near-term phenomenon, in my view, over the next couple of quarters. But if you really look at the real reason why the IT companies are doling out those types of salary hikes is because they are seeing the demand visibility. I think you clearly have the demand visibility for the next 18 to 24 months. And in that context, and what we understand is that there is still no increase on the pricing front, so to speak, because the domestic companies are clearly trying to gain market share. So my view is that yes, there will be a couple of quarters of some kind of a margin turbulence, and the investors who can stomach that should continue to stay invested here. Because I think it will be a matter of time before the price improvement begins to kick in, because even in the US job market, especially in the white collar job market, there is a reasonable amount of tightness. And my sense is that, give another couple of quarters and the price hikes will begin to, come in, and the margins will begin to get normalized. And the historical trend suggests that the market and the investors reward revenue performance more than some kind of a disappointment on margins. So I think if the margin disappointment stays within the limited, say around 10, 20 basis point, 30 basis point, something like that, I think it should still be okay. So I think clearly the focus should be on those companies that will be able to handle this margin pressure better. And I think the large caps will be better at doing that.
So what is the fair value, do you mind, for IT? Let's put all the factors into play. Margin, little bit of contraction and a double-digit volume growth for FY23. And with a little bit of rupee depreciation, if you put all the basic factors which drive growth, which is top line growth, margin sustains and rupee supports, then what is the best case scenario for IT stocks in FY23?
Yeah, I think the stocks still have a double-digit upside in my view, and I'm putting that in the context of where my broader market views are. I personally believe that the market outlook as a whole is looking quite, quite subdued in my view because of where we're sitting right now. So while you said that, okay, what's the big deal about a 10% return? But I'm just putting that in the context of my view, where I feel the market as a whole is going to give. Just be sideways in my view.
Why sideways, Mahesh? Why don't you think markets could come down? We've had a huge move this year, which was followed by a great move last year. If markets have to correct, uh, what could stop the market from correcting 10-15% from here? Because 10-15% correction is not going to hurt anybody.
Oh, absolutely. There is, one cannot say that the market will not correct by 10-15%. It's quite possible. And I think uh, I'm actually seeing a reasonable probability, of that happening. But because, the reason why I said, with a 12-month view, 6 to 12-month view, it's still going to be a sideways market, is that while there will be a dip, most likely in my view, but I think that dip will be bought into because the economic tailwind is pretty strong. And if you look at the corporate earnings trend, if you look at the broader the GDP growth trend, etc., I'm quite optimistic. In fact, we talked about this housing market revival many times on this channel in the past as well, which I think will be a key driver for the broader economic growth. So yes, there will most likely be a dip in my view, but that dip will be bought into by most of the market players. So that's the reason why I'm seeing that over say a 6 to 12 month period, the market as a whole may not be down, but it would probably just be sideways.
Mahesh, I have reported several bull markets in the last 23, 24 years of my career. You've written about several bull markets in your career as a strategist, as an analyst. Every bull market normally goes through a correction, 5 to 10%, and that is considered as par for course. But this bull market, which started in April 2020, has not seen a single 10% correction. What is so unique about this bull market? I was looking at S&P charts over the weekend, and the S&P has not corrected even 5% at a stretch from November. Isn't this crazy?
It is. It is absolutely. This type of a unidirectional movement in the market, as you rightly mentioned, has not really been observed in the past. And yes, I mean it is basically just the coordinated efforts of all the global central bankers and the continued belief that this is going to be this way. But yeah, I mean, to be honest with you, I don't really have a very specific answer to this very very unidirectional move that we've seen, and that's the reason why I feel that this longer the market runs in this unidirectional manner, greater are the chances that the type of correction that you talked about is more and more likely.
Sure. Mahesh also wanted to understand whether or not, I mean, I know no market can, be unidirectional, and at some point we are going to stall. We can't continue with the same pace on a daily basis. But just wanted to understand what you're making of the sectoral churn. And not just the sectoral churn, the churn within sectors as well. For instance, we've all, seen and talked about the diversification within banks, for instance, wherein ICICI Bank, SBI are taking leadership, HDFC Bank has just begun to catch up in the past month, and then names like Kotak Bank continue to lag.
Yeah, I mean, I think clearly, what we have been seeing is that the trend in terms of the thought process of the global investors and also the local investors has changed, and uh, we are kind of assuming that the growth is going to revive. So the kind of premium that the market was willing to give to the predictability and the stability of growth, which was enjoyed by a lot of defensive plays, isn't there anymore. And I think the market is now rewarding those companies and those stock prices which were first of all were impacted when the growth was slower during the second half of the last decade, and also where there is some sense of risk appetite, and where the companies can benefit from the economic revival, the cyclical revival that we've been talking about. So I think that is clearly going to be the case going forward as well. That growth outlook is definitely looking better. We are quite optimistic on the economic outlook. So yeah, so I mean, don't mistake my slightly not so exciting views about market, with the not so exciting views on economy. I think I'm very bullish on economy. I think the economic revival is just around the corner. We're already going through it as we speak. But I just believe that the economic cycle and the market cycle have to be differentiated. And so while I'm very bullish on the economic cycle, I'm not so bullish on the market cycle, at least in the near term.
I guess that's what explains your Capex overweights, which are heavily skewed within the capital goods segment. I see L&T, Siemens and ABB.
Yeah, that's right. So, we believe that the housing, market revival will eventually lead to a broader Capex revival as well. We're already seeing some initial movements on the infrastructure side. Within the corporate cycle side, there are certain industries like the steel, which is driving the Capex. PLI is going to drive a few things. Data center is a new emerging theme. But yeah, the broader Capex cycle is still going to take some time because the capacity utilization still is at a very low level. And I think, it will take, 2 to 4 quarters for the broader Capex cycle to be seen. But yeah, I think we are clearly seeing the, some initial signs of it.
All right. Okay, Mahesh, you spoke about banking and financial, but within that space, how do you see, because banking and financial as well, now there are different subcategories. You have the PSBs, private banks, then the smaller private banks, small finance banks, etc. So, and you made a case, of course, about how a Capex cycle could come back. Which, segment do you think has the opportunity or is best placed to grab that credit growth potential?
I think given where the valuations are of many of the large private banks, I still feel that the large private banks makes the best risk reward. Although one might argue that in the Capex revival theme that we're talking about, the smaller NBFCs and banks will probably give better returns. Well, that is the case. But I still feel that we are not still completely out of the woods in terms of the asset quality question marks. And I'm not forced to look at the small banks and the small NBFCs just as yet, because the large banks are still trading at reasonable valuations. So from the risk reward perspective, I feel the large private sector bank still offers the best risk reward, in my view. And yes, within the broader banks and financial space, the non-lending part, especially the insurance side, is also looking pretty attractive.
Okay. All right. Well, we leave it at that. Mahesh, thank you so much for taking our time and joining us this morning on ET Now.
Thank you very much.